Welcome to Your Money Guides, brought to you by Interface Financial Planning. Hello. In this episode, I want to talk to you about venture capital trusts, enterprise investment schemes, and business relief. For those of you who are looking for more adventurous investments or highly tax-efficient areas, or both, there are some enticing options available to you. These include venture capital trusts, known simply as VCTs, enterprise investment schemes, or EISs, and business relief qualifying investments. Standalone or combined, in the right circumstances, these options can produce attractive and dynamic investment possibilities, financial planning outcomes, and tax efficiency. My aim in this guide is to provide an outline of how each works, to identify where and when they may be used, and to include some simple examples of their application. However, a word of warning from the start. These are investments or areas for more experienced investors. They are often considered high risk and should only be pursued once expert and appropriate regulated advice has been taken. So to start with, let's look at venture capital trusts. VCTs are listed companies. Their purpose, however, is to act like a fund, in the sense that they invest in other companies and small businesses that need investment. You invest into a VCT, which in turn invests into a pool of smaller companies, which are either unquoted or listed on the AIM. This stands for the Alternative Investment Market, and this is a sub-market of the London Stock Exchange. This means these underlying companies and their shares, which are acquired by the VCT, are sometimes referred to as being illiquid. This makes them higher risk and in adverse circumstances could be difficult to buy and sell. To encourage investors back to smaller companies in this way, the government offers a series of tax benefits to investors who invest in VCTs. Firstly, income tax relief of up to 30% on the invested sum, tax-free dividends paid to investors from any profit generated, and also an exemption from capital gains tax. VCTs don't offer any inheritance tax exemption. The value of the VCT will be included in an estate upon death. These tax advantages can complement other financial planning strategies, including pensions and individual savings accounts or ISAs. I will look further at the tax position, how they compare to the other options, the risks, and the general rules, such as the amounts you can invest, a little later on in this guide. Now let's look at enterprise investment schemes, or EIS. As with the VCTs, the concept behind EIS is to allow investors to support smaller companies at their inception or early growth stages, and in return receive as an incentive for the risks involved generous tax breaks. VCTs will always be pooled investments, investing into a pool of underlying companies. EIS can either be made through a fund, a similar idea where the fund invests into a pool of companies, or it can be into a single company. That's the difference to the VCT option. In addition, the EIS has a further part to it known as the Seed Enterprise Investment Scheme, or SEIS. This is specifically to back very new companies or startups and offers enhanced tax benefits. To encourage investors to support investment via the EIS or the SEIS, there are tax benefits, and these are different to the ones available via VCTs. There's income tax relief of up to 30% on the sum invested. This is 50% for SEIS. There's exemption from capital gains tax, and if losses are incurred, these can be offset against income tax. This is known as loss relief. There's also freedom from inheritance tax after 2 years via business relief, and deferral of capital gains tax incurred on disposal of other investments. Again, I will look at the tax position later on. Now let's look at business relief. Business relief is a tax relief given under the inheritance tax legislation. It was originally introduced to allow business owners to pass on businesses to their beneficiaries free of any inheritance tax. The reason was to prevent businesses from having to be sold on the death of the owner to meet an inheritance tax liability. There's no cap on how valuable a business may be, so even a business worth many millions would be nil rated for inheritance tax. Today it's more widely available to private investors, and this means any qualifying investment held for at least 2 years will have 100% relief from inheritance tax. An investor can buy shares in a company which meets the qualifying criteria, and the value of those shares on death will be free of inheritance tax, provided they have been held for 2 years. Shares in AIM-listed companies and unquoted shares can also meet the qualifying criteria. EIS investments can also qualify for business relief due to the investor buying shares directly in the company. VCTs, being collective fund-like investments, do not qualify for business relief. So how about the tax planning and the tax efficiency of each? You will note from the basic outline of each of these three different investment options and the tax positions relating to each that there are a host and a variety of favourable tax breaks. How to use these in your situation will be influenced by your own tax position and your long-term financial planning goals. It's worth highlighting an additional point here. The two most mainstream tax-effective investments are generally considered to be pensions and ISAs. Both have attractive tax breaks attached, but both have limitations which can sometimes cause difficulties. For example, pensions have limits on how much can be paid into them, a contribution limit, and a maximum amount that can be accumulated before a charge is imposed on the excess, a lifetime allowance. When these restrictions become relevant, then the alternatives of a VCT or an EIS can become very attractive, as both allow for much greater annual investments to be made, but still with the 30% income tax relief applied. An ISA, whilst allowing for sums to be accumulated inside a tax-free account, will become part of an estate on death. The option of an EIS or a BR qualifying investment, where there is no IHT, becomes very attractive in comparison. The ISA rules now include AIM ISAs. This means ISAs will qualify after 2 years for freedom from inheritance tax. I now want to look at how the schemes compare. So firstly, the maximum investment amounts. With VCT, the maximum annual investment is £200,000. With EIS, the maximum investment is £1 million per year, which is raised to £2 million if at least £1 million is invested in knowledge-intensive companies. Second is holding periods. With VCT, the investment must be held for a minimum of 5 years to be eligible for tax relief. EIS, the investment must be held for a minimum of 3 years to be eligible for tax relief. Both VCTs and EIS provide 30% income tax relief. Next is dividends and capital gains. With VCT, dividends and capital gains are free of tax. There is no minimum holding period relating to these reliefs. However, dividends from an EIS investment are taxable. There is no tax on capital gains. The investment must be held for a minimum of 3 years to get the freedom of capital gains tax. Plus, if the investment incurs a loss, loss relief is available. This means the value of the loss can be offset against other taxes. Then there's capital gains tax deferral. With VCT, capital gains tax deferral is not available. However, with EIS, capital gains tax deferral is available. This is not limited to £1 million. It can be higher. Capital gains from 3 years before or 1 year after can be invested into the EIS. The deferral means the tax that would otherwise be payable on disposal of an asset is held over until such a time as the EIS itself is cashed in. This means investors with large gains can shelter those gains for many years. And finally, there's inheritance tax. The value of a VCT will be included in an estate for inheritance tax purposes. An EIS will not be assessed for inheritance tax on death if it's been held for a period of 2 or more years. There are many other technical aspects which I'm not detailing within this guide. For example, the ability in some cases to carry forward and back investments made between tax years, or the different qualifying conditions for different types of business assets for BR. Such details may be incredibly important to decisions that you make in the future. These details can be explored when your personal position is assessed with a professional advisor. I now want to look at some examples of how investors use the schemes. The use of VCTs and EISs is very much dependent on a mix of the individual's financial situation, including their tax position and their long-term goals. How to integrate this with the use of business relief is likewise circumstantial. So here are some basic ideas and examples of where the schemes can be particularly attractive. Firstly, pension planning. Rarely is a VCT or an EIS a good substitute for a pension. However, where annual pension contributions are being maximised or the lifetime limit for a pension is a factor, then supplementing with a VCT makes perfect sense. Secondly, retirement income planning. VCTs offer tax-free dividends, and many VCT funds use this to actively pursue a strategy of making regular payouts. This means investors can make an investment into a VCT, obtain 30% income tax relief, and then receive a tax-free annual income. This can be very attractive to those investors looking for an income from invested capital in retirement. Thirdly, there's offsetting a large capital gain. Take the example of an individual making a £100,000 capital gain, and this attracts a capital gains tax of £28,000. The individual can use an EIS investment to defer that tax. They don't need to pay it, or they can get it back if previously paid. They will also be entitled, if they have enough income, to income tax relief of £30,000, reducing the cost of the EIS investment to £70,000, or £42,000 if the deferred gain is considered. They have £100,000 in the EIS to hopefully grow. The £28,000 tax is payable later when the EIS is disposed of. Next, there's selling a business. Business relief should be a significant consideration for people selling a business. The irony is that shares in a limited company often, but not always, automatically qualify for BR. But once disposed of, the cash value achieved immediately becomes liable to inheritance tax. For example, if Bob sells his business for £1 million, he now has £1 million, and this would be subject to inheritance tax. If Bob reinvests his sale proceeds into a BR qualifying investment, he continues to enjoy the freedom from inheritance tax and will still have access to the funds. And finally, inheritance tax planning. A couple in their late 80s have significant assets and now need less income than earlier in retirement. They have not made outright gifts through their retirement as they were unsure how much money they would need. But they have reached the stage where they can comfortably make gifts from their estate, but realise that doing so may involve living 7 years for the gifts to be free of inheritance tax. They can consider instead using a business relief qualifying fund, which brings freedom from inheritance tax after just 2 years. Also, if circumstances change, the BR investment is still available for them to access in the event of an unexpected need for cash, for example healthcare. So how about the risk involved and other considerations to take into account? In simple terms, VCTs are operating in the same way as a fund, whereby you invest into a VCT, which in turn invests into a reasonable number of small companies. An EIS, on the other hand, is an investment into a single company. However, it's possible to invest with an EIS manager who runs an EIS portfolio, which invests your money into many different single company investments, thereby creating the effect of an EIS fund or portfolio. In both cases, the VCT fund and the EIS portfolio, you can diversify the money you allocate into a reasonable number of companies. This diversification is important in terms of risk. The nature of the companies that qualify for VCT or EIS investment is that they are smaller, early stage or growth companies, which makes them riskier than, say, a large established company listed on the main stock exchange. This is high risk investing, and the ability to diversify offsets this to some degree. The risk can be defined in a couple of ways. One is that the share price of any company could fall, even to zero, which is a total loss, and prices in such companies are likely to be more volatile than most other investments. The other risk is that the market for the shares may be illiquid. There is no guarantee for a buyer, whereas with mainstream shareholdings on a major exchange, one would expect to always find a buyer. With these smaller company shares, this may not be the case, especially in difficult times. Therefore, the more you can spread across a basket of smaller company shares, the less chance of outright loss. I want to finish by talking about taking advice. The risks and complexities of VCTs, EISs and BR are such that seeking professional advice is of paramount importance. In this guide, I have outlined the main points for anyone to consider, but the full extent of the technical factors involved, some of which I have not covered, make this an area of financial and tax planning where it's easy to trip up. Moreover, any individual will have various options available to them, which could be a straight choice between a VCT or an EIS, or a combination of both, including the use of business relief. You will also have various options towards different VCT or EIS fund managers, and will need to select which ones to work with, Again, specialist advice could make a big difference in this regard. Maximising the position favourably, and even the question of whether these are suitable options, needs the help of an expert. Thank you for listening. For more information, visit our website at interfacefinancialplanning.co.uk.